Politicians continue to buy stocks, and today we have access to their more recent purchases just over the last few weeks. And we're going to look at the top 5 most sports stocks. The first one, in fact, is Dell Technologies. Now we're going to do an in-depth deep dive of each one and give you our view as to whether or not we believe they are undervalued. The first one, well, Dell, as we can see, does get a triple buy rating with a strong buy from Quant. Now, this is quite rare, just to think the majority of stocks that we do look at, Quant does give it a hold. Right now, it is trading in the mid, you could argue, towards the lower end of the 52-week range. Still very strong performance, up 107% over the last 12 months. And over the last 5 years, we can see up 303%, massively outperforming the S&P during that same time. It also does pay a dividend on a forward perspective, 1.6%. On a forward B basis, well, 14.4%, significantly lower than the S&P, which trades right now at a forward valuation of 23. In terms of the dividend safety, well, it sits at 70, so we can take a look at the supporting metrics. And the most recent increase came in March this year at 20%, very, very high. Now, what does a 70 safe score mean? It effectively means that a dividend cut is unlikely. And for those that want to see, in the last recession, in terms of sales, Dell had negative 19%. Now, this was below the S&P during the same time. That was around negative 12%. As we mentioned, 20% increase just this year, and we can in fact see this is the first year that they have been paying a dividend without a reduction, and we can see they only have 1 year of consecutive increases, although they had paid a dividend in 2013, only to cut it in 2014 and reinstate it in 2023. So in terms of dividend yield theory, now we do typically use this to see undervaluation when the yield sits above the 5-year average, but given their dividend has been on and off, not something we will focus on. What we can see though, on a forward P trading at 13.5, it does sit higher than the 5-year of 9.1. However, when we look as a whole in terms of the sector, information technology sits much higher at 25.5. In terms of the free cash flow payout, given they've only recently started to pay a dividend and we like to see below 60%, what we can see in 2024, 18%, over the next 12 months at 25%, does let us know that there is significant room for this company to accelerate that dividend growth. Free cash flow per share, as always, what we want to see here, increasing consistent numbers over the last 10 years. We note a lot of inconsistency. Yes, it has increased from 2015 to 2024, but year on year, lots of up and downs. And in fact, over the next 12 months, we do anticipate this to drop slightly to 715. In terms of sales growth, well, we do also have to point out 4 of the last 10 years have been negative growth, most notably the more recent year of 2024. And when we zoom out and look at it numerically, we can see they have increased that number 54 billion to 88, but again, we can see the revenue did peak around 2023, so hopefully we can see them moving forwards start to increase at a much rapid rate. In terms of shares outstanding, whilst we love to see returning of excess cash, we've actually noted the opposite over the longer term. They would have in fact diluted your position as a shareholder if you had bought from 2015 to 2017. Then we move on to one of my favorite metrics, the ROIC, return on invested capital, 10% or more. Give us that faith management are able to effectively allocate their capital. And from 2022, it has started to look very strong in the high teens, low 20s. Ideally, though, we do want to see this consistency. What we do note from 2015 to 2018, given it was negative, then this company hadn't turned a profit during that period. Again, that does make it a lot clearer when we do look at their margins. As we mentioned, 2015 to 2018, negative margin. It has started to pick back up though over the years, but we want to see a minimum of 12%, just something to keep an eye on. In terms of the free cash flow margin as well, lots of inconsistencies across the board. 2023, whilst it did drop to 1%, the positive to note here, 2024, it did rebound up to a nice 7%. We then look at the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. The numbers that you can see below do reflect the number of years it would take the company to pay off all of their debt net of cash on hand. Whilst we want to see below 3, nice to note from 2021, it has been below that, 1.14 expected over the next 12 months. So no real worries. Balance sheet based on this does look very good. The dividend, again, based on the low free cash flow payout, does also look secure. As always, they're important to understand the valuation, and we can see our intrinsic value today of $169 isn't dissimilar from Wall Street. Their price target of $165 does imply upside of 46% over the next year. Now, as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And typically how we get to these numbers, when we do a deeper dive for each one of these, we do run into each one of these models, explain the inputs and the outputs. Today we're going straight in, and as always, we want an MOS level at least 10%, and that is reserved for companies that meet our 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that for Dell today, we'll buy up to $152. Then we just keep going till it is near that current trading price. 20% MOS at $135, 30% at $118, and it's not quite at a 35% level just yet. So in today's episode, if you are a believer in this company over the longer term, you like the metrics, you are getting a 30% MOS with Wall Street, as we can clearly see, believing this to be a very strong contender for a new ad or an additional ad in the portfolio. As we said, double buy with a strong buy from Quant. Now, before we continue, just to let you know, we have released our latest weekly article. If you want access to this or any other articles, click on the pinned comment below. You can sign up and read straight away. A lot of information in these articles, especially around undervalued companies that are worth considering. We then move on to Applied Materials, the second stock that these politicians are buying. Now, this one is up around 47% over the last 12 months. Over the last 10 years, massive outperformance of the S&P, up 872%, now trading in the mid to upper of the 52-week range. Just a buy from Wall Street, although we do get a 4.08 out of 5 with a hold from the other 2 analysts. A yield but lower than what we saw previously with Dell, 0.79%, and we can see a forward PE 24, marginally higher than the S&P. When we talk about dividend safety, well, an 86, a very safe score, and another very nice increase to the dividend in the same month as well, March of 24 at 25%. So what the very safe score ultimately means is that a dividend cut is highly unlikely. Now, in terms of the last recession, Applied Materials unfortunately maintained the dividend in the Great Recession. They didn't increase it, they didn't cut it. They had below average growth, but pretty much a near S&P return in 07-09 of negative 57. In terms of increases, as we mentioned, this is a company that does some very nice double-digit increases on a consistent basis over the last 10 years, but they have been increasing the dividend for the last 6, whilst paying a dividend without a reduction for the last 18. When we then look at the dividend yield theory, we do note a sense of overvaluation based on the yield as well as the forward P. When we do look at the information technology, it does sit marginally higher. But remember, we never look at any of these in isolation, and we do conclude when we look at the valuation. In terms of free cash flow, well, below 50 for semiconductor specific industry, very low, 13% in 23, 19 over the next 12 months. So again, very easy to see how they can offer those strong double-digit increases. Free cash flow per share looking very attractive as well, some very nice growth over the period, but again, a slowdown expected into 2024. In terms of sales growth, well, nearly every year, strong double digit. We do note 2023, the more recent year, of 3%, which is really at the lower end of what we want to see, but again, something just to bear in mind, as historically, they have shown some very strong numbers. This has meant, though, numerically, they have nearly tripled their top line over the last 10 years, and we always love to see this. Companies that do essentially very strong double-digit increases to the dividend, also doing a lot of share buybacks that we can clearly see AMAT have been doing. We then look at the ROIC, very strong. In fact, instead of 10, we move it to 12 for semiconductors, increasing as well over the period in the 30s and 40s over the last few years. Always love to see very good metrics on ROIC. We then move on to the margins, again, not only above the minimums on the operating, but as always, we see this operating efficiency with the margins increasing. When we combine this with revenue increasing, this is really what we define as a high quality company, and we can see here free cash flow margin looking very, very healthy. You could argue that Applied Materials is a free cash flow machine. On top of that, there is nothing better than I like looking at a net debt to EBITDA metric seeing 0, which we get in 23 over the next 12 months as well, indicating it won't take this company one day to pay off all of their debt net of cash on hand. Also remember, with the valuation model, you can pick up a copy by clicking on the pinned comment below, running in your own numbers, or whether you want to look at other companies. Our intrinsic value of $235, when we put it in for an MOS at 10%, around 212, at the 15% level, not too far off, but not quite there yet, so nowhere near as much of a margin of safety as Dell Technologies, sitting around 10 to 15% today. With Wall Street, though, they are bullish. They do have upside of 21%. Their price target, $247. And as always, let us know your thoughts as we do go along these stocks today. We then move on to Old Dominion Freight Line, which I do consider a very high quality company. We only have a buy there with Seeking Alpha as a 4 out of 5, with Wall Street and Quant giving it a hold. It does trade in the mid to upper end of the 52-week range, a fairly low yield at 0.51%, and a fairly high forward P at 36.1. Now, over the last year, it is up around 3%. Over the last 10 years, again, another significant outperformer of the S&P, around 857%. Another very safe dividend score and another very large dividend growth of 30%. Looks like politicians do like to see their dividends growing very rapidly. And when we do take a look at the last recession, we do note below average growth, but significantly outperforming negative 22. And then we look at dividend growth over the last 5 years as well. This is a company that continually increases the dividend at a very impressive rate. And we also note they have only been increasing a dividend for the last 6 years. Now, when we take a look at dividend yield theory, we do note an undervaluation signal on the yield, 0.51% versus the 5-year average of 0.4, but we do, however, note contradictory evidence, 34 on the forward P versus the 30 on the 5-year average. We also do note industrials is significantly lower, but as always, within this bucket for the sector, there will be a lot of low quality companies that don't match Old Dominion and their metrics. In terms of the free cash flow payout, well, consistently below 30. Again, do bear in mind, these are some of the themes that you can identify when why companies are able to offer such a nice growth to their dividend. And we can see free cash flow. I mean, that is some very nice consistent growth over the longer term. Granted, there are some years where it drops marginally, but then continues to bounce back year on year. Over the next 12 months as well, expected to increase from the 2023 figure. Over the last 10 years, they have had 2 years of negative growth, notably 2023 at negative 6%. But again, when you do zoom out, pretty much doubled their top line over the period, whilst also not just a nice double-digit dividend increase, but they have been doing some share buybacks, returning that excess cash. Not massive, but again consistent, a few million shares year on year. We then draw your attention to the ROIC, so you can start to understand why I do like this company. It does have a lot of very high quality metrics, 34% in 23, 40% on a trailing 12-month basis, and the margins also sign of operational efficiency, 28%, again very healthy for 2023 and for the industry, and the same to be said for the free cash flow margin, which does make us believe the one area that we will need to consider in depth is the valuation. Just look at that, the net debt to EBITDA, phenomenal balance sheet as well, zero pretty much over the last 6 to 7 years and anticipated over the next 12 months. So look, in terms of valuation, our intrinsic value at $205 isn't too far off the current trading price, which also isn't too far off Wall Street and their estimations. So we do pretty much see this company right now trading at a fair value. A lot of people will be happy to buy companies at a premium at their fair value, or even just a 5% margin of safety. But let's run the numbers through. A 5% margin of safety would be a buy at 195. At 10%, around 185, which is ideally where I would like to look at this company if it does come down to that level. At 15%, again, looking around 175. As always, let us know your thoughts, as I do know a lot of people in the community also have ODFL on their radar. The next stock they've been adding is JPMorgan. Now, this has a double buy rating with a hold from Quant, trading towards the upper end of the 52-week range, just a few dollars shy from all-time highs. In terms of the yield, well, 2.2%. In terms of the forward PE, just over 12. And over the last year, very nice, outperforming the S&P during that period. And over the last 10 years, again, outperformance up 273%. In terms of dividend safety, well, 70 safety score, and they did in fact increase the dividend just last month at 8.7%. Again, very nice to note. And in fact, their dividend safety was upgraded on May of this year, going to a nice safe score. Therefore, a dividend cut does look to be unlikely. When we look at the last recession, well, we do in fact note they did cut the dividend, no surprises there, below average growth, and also trailed the S&P negative 65%. We do like to see this nice high single digit, not just this year, but over the last 5 years, and over the last 20, they're at least increasing it higher than the 4% inflationary rate we do always discuss on this channel. with 13 years of consecutive increases. In terms of dividend yield theory, well, we actually get a sign of overvaluation, yield lower than the 5-year average, forward PE marginally higher than the 5-year rolling, and we know that it isn't too far off the financials that sits around 12. Talking about JPM, with respect to the metrics, we do have to look at the earnings payout ratio, given the fact that the free cash flow is a lot more volatile for banks. Below 40% is what we want to see. What we get as well pretty much every single year, 31% anticipated over the next 12 months. Earnings per share as well, nice, increasing pretty much on a year-on-year basis. Expected over the next 12 months to be fairly flat from the previous year, so something just to bear in mind. And then when we take a look at the EPS growth as well as the sales, we can see a lot of cyclicality, quite a number of years of negative growth on both sides. So again, bear that in mind. Sometimes it is good to look at these companies when they are out of favor, out of cycle. And in terms of the total figures, well, they have been increasing their top line over the period, and more impressively, they have been doing quite a lot of share buybacks. In fact, when we take a look, it's gone from 3.8 billion down to around 2.9, so nearly 1 billion, in fact, worth of share buybacks just over the last 10 years. Return on equity as well, above 9% for banks, been above that every single year, 16% in 2023. Now, the other metrics that we do like to look at, as we said, they aren't relevant for banks. One of the main reasons, as we can see here, the EBITDA isn't meaningful for banks, as interest is one of their core components in both the revenue as well as expenses. In terms of valuation, our intrinsic value at around $190, it does show that we do believe this company now to be overvalued, or you could argue trading at a premium. In terms of Wall Street, well, they pretty much see around 5% upside over the next 12 months, so they don't believe this is a must buy, maybe something to consider as the share price drops. In terms of our margin of safety, if we were to consider this at 10%, we would be looking around $171. As always though, a lot of people may disagree, whereas some people may also believe this does look to be overvalued, has been on a very large run just over the last few years. This then takes us to Duke Energy, where we get a double buy and a hold from Quant, trading right there near its 52-week high. Forward yield just under 4% with a forward P just over 18, and over the last year up a respectable 14%. Over the last 10 years up around 48%. We can see all-time highs sitting around April 22 at $115, not that far off the current trading value. We get a safe score of 80, and they did increase their dividend, in fact, just this year at 2%. Bear in mind, we do really want to see 4% as that bare minimum. Key metrics from the last recession, well, they increased the dividend, they had above average growth, and they also significantly outperformed the S&P 500. But something we do know with this company, very consistently do offer a very mediocre, or what we would believe to be a very mediocre increase year on year. They have, however, been increasing those dividends for the last 16. When we talk about dividend yield theory, we get a sense of overvaluation on the yield with a reasonable valuation when looking at the forward PE, and we do note again marginally higher than the sector at 16.8. Now, utilities, similar to banks, the free cash flow numbers are a lot more volatile, therefore we do draw your attention to the earnings below 75, and look, it's pretty much straddled around that year on year, so no worries, pretty consistent, and 70% expected over the next 12 months. In terms of the earnings per share, well, that does increase pretty much year on year, very consistently and very marginal, expected again to increase over the next 12 months. And when we look at that on a percentage wise, we can see nothing too massive. Don't expect the large rates that maybe we get from the tech companies or other industries. And on a sales growth, again, very, very consistently around the 3 to 7% level for the large part. Then numerically, we can see 22 billion in 2014, 28.6 in 2023. So if you do factor in the 4% inflationary rate, you could argue it isn't increasing in terms of real numbers. In terms of shares outstanding, well, bear in mind for utilities, they will dilute your position as they need this, as we can see, to fund a portion of those growth expenditures. We then move on to the ROIC, where we can see above 7.5 for utilities. It doesn't hit that at all, around 4 to 6% year on year. And when we look at the margins, pretty consistently around the 24-25%, but that is above what we want to see for utilities, so no worries when looking solely at the margins. Finally, the net debt to EBITDA, we bring it up to 5.5 for utility industry, pretty much nearly above that every single year, 6.34 in 23, and even though it is anticipated to lower over the next 12 months, still above what we are comfortable with, so again, just bear this in mind. Finally, our intrinsic value of $106, not dissimilar from the current price, not dissimilar from essentially Wall Street and their targets. So again, another one very similar to other companies we do believe trading at its fair value. Now, if you wanted a 10% MOS level, we can see an acceptable buy at $95. At around 15%, you would need to wait for around $90. Now, if you want to see other companies that are severely undervalued that we are considering adding, do go check out our newsletter or do come and join us in the Patreon. Give us your thoughts below. And as always, if you enjoyed the episode, smash that like button, hit that subscribe and bell button, and we'll see you all on the next one.